So, we have completed the first lecture of module 5 and now we are entering into the second lecture of module 5. This particular lecture is based upon the interest rate structure. So, under this particular topic what we are going to cover, what is bond yield, what are the different types of yield curve, what determines the term structure of interest rate. So, there are certain theories related to it, determinants of interest rates, then implication of interest rate structure and the application of interest rate structure. So, on the basis of this we are going to discuss or elaborate this particular chapter. The first term is bond yield. So, the term structure of interest rate is popularly known as the yield curve. So, when we talk about the bond yield, it is basically the yield curve or the term structure of interest rates. So, whatever the interest rate the particular bond is getting for a particular period of time, and it is shown through a particular yield curve. So, in this particular example we can see the interest rate is this, current price of the bond is this and the yield to maturity is this. So, this yield to maturity is basically the term structure of the interest rate. So, on the basis of this interest rate, this yield to maturity is calculated. So, the term structure is popularly known as yield curve, which as already mentioned, which shows how yield to maturity is related to term to maturity for bonds that are similar in all aspects excepting the maturity. If a particular bond which is different on the basis of maturity, if a particular bond is 6 years and another bond is 10 years, the yield to maturity will going to differ just on the basis of that. But if the interest rate is same, they are going to go at the same level of yield to maturity. So, this particular statement I am again repeating it, the term structure of interest rate is known as yield curve, which shows yield to maturity and it is related to term to maturity for the bonds that are similar in all aspects except the maturity period. So, this particular interest rate, when we are talking about the maturity period is 5 years and we calculate the yield to maturity, it is going to differ. So, yield curve for the above bond is shown below in this particular diagram. It slopes upwards, indicating a long term interest rates are greater than the short term interest rate. So, we have seen that the yield to maturity starts with 12.40. So, here there is a break and it is starting from 12.40 and it goes up to a point where the maturity is, that is 13.90. So, yield curves however do not have to necessarily slope outwards, it can be downward sloping, it can be humped curve, it can be a particular flat curve, it depends upon the structure or the yield to maturity it is generating. So, in next particular topic that we are going to discuss is the types of yield curve. Here I have mentioned the upward sloping yield curve, downward sloping yield curve, flat curve and hump shape curve. Now, I am going to explain this in detail. So, what is the upward sloping curve? Upward sloping curve is a normal curve. So, in this previous example we have seen that the yield to maturity is increasing. So, we can say it is a normal yield curve because every investor expects that the yield to maturity increases for a particular period of time. So, it is the most common shape where longer term bonds have longer yields than shorter term bonds. If the bond is long term, in that case the yield to maturity increases, or we can see the yield curve is increasing or upward sloping. But in case of short term bonds, there are chances that yield curve may differ. So, it reflects the expectation of economic growth and the moderate inflation as investors demand higher yields for long term investment to compensate for the risk like inflation and uncertainty. So, why this particular curve is upward sloping? First quality or first characteristics of a normal yield curve is that it is long term. Second, since it is long term, it tries to cover certain portion of risk and this risk may be related to inflation and economic uncertainty. So, The bond issuer need to cover these two things if they are issuing a long term bond or the bond which has a higher maturity period, suppose 10-year bonds or 15-year bonds or 20 years bond. In that case, the rate of interest or yield should go increasing, otherwise the bond holder will lose their money. So, the steeper normal yield curve often signals stronger economic growth expectation, and with a flatter curve indicates slow growth indication. So, if we look into the normal curve, if it is growing at a speed, in that situation the economic expectation of the investor or bond holder is quite high, because the economy is growing and they also demanding a higher rate. And if it is growing, but at a flatter rate or very low rate, in that condition the expectation is low, the economy is stagnant or there is no growth in the economy, it is going normally. In that situation it is showing a upward curve, but it is a flattening one. Now, second one is inverted yield curve, that is downward sloping. This is the particularly inverted yield curve. Now, why this particular yield curve is downward sloping? An inverted yield curve occurs when shorter term yields are higher than the longer term yields. This unusual shape often signals expectation of recession or economic downturn, as investors expect lower future interest rate due to falling growth or deflation. Historically, an inverted yield curve has reliable predictor of recession. If the investor predicts that there is a recession and that is coming in near future, in that situation what happens, the shorter yield curve will be higher or it is upward sloping, and the longer yield curve will show a downward pattern. So, in case there is economic downturn or recession, or the forecast that the economic situation is not going good, in that situation we can see the inverted yield curve, otherwise it is not visible. Next one is flat yield curve. Flat yield curve, just look into the flat yield curve, is a straight line. So, a flat yield curve indicates short term and long term yields are close to the same level. So, it signals uncertainty about future economic conditions or potential shift from growth to slowdown. It can also occur during transitions, such as when economy is moving from expansion to contraction or vice versa. So, this situation or flat yield curve situation occurs when there is a tandem between short term and long term yield levels, and in that situation we can see the flat yield curve. Humped or belt shaped yield curve, it is like this. This is a humped shaped or belt shaped yield curve. In this situation what happens? Curve has a higher yields at medium term maturity. Till now we are talking about short term and long term. In hump shaped or belt shaped yield curve we are talking about higher yields at medium term maturity period, that are short or long maturity. So, they are getting higher yields in medium term, but in case of short term and long term we are getting low yields. So, it is less common and typically signals short term uncertainty, where interest rates are expected to rise in the near term, but fall over the long term. So, this particular hump shaped curve occurs because it shows during a particular point of time there is an increase, and after a point of time there will be a decrease. So, in short run there will be increase, and in long run there will be decrease in the yields, but for medium range there is they are, as compared to both the short term and long term, it is higher. So, there occurs a hump shaped curve in the yield. So, these are the 4 types of yield curve. So, regularly we basically see the normal yield curve, which is quite popular. Now, what determines the structure of the interest rate? So, there are certain theories based upon that the structure, or we can say the term structure of interest rate has been decided. So, these theories are the expectation theory, liquidity preference theory, preferred habitat theory, and market segmentation theory. So, first one is expectations theory. This theory holds that shape of the yield curve can be explained by the interest rate expectation of those who participate in the market. If the expectation is high or if they see that there is a economic growth, in that situation the normal yield curve will be there, and if they see the market situation is not normal and it is going to go down, in that situation it is showing a downward sloping curve. So, this particular theory is based upon the expectations of the investor. So, more precisely, the expectation theory holds that any long term rate is equal to the geometric mean of current and future 1 year rates expected by the market participant. So, this is expressed in terms of this particular formula, where TRN is the actual long term rate, this is the TRN is the actual long term rate, N is the term of maturity in years of long issue, TR1 is the current year rate, TIR1 is the expected 1 year rate during the future period. So, on the basis of that, this particular yield curve is decided. So, this theory explains any shape of the yield curve, whether it is ascending, descending, humped or flat. Ascending means increasing, descending means decreasing. So, ascending short term rates are expected to rise in future. In case of descending, the short term rates are expected to decrease in or fall in future. Humped shape, short term rates are expected to rise for a while and then fall, as I already mentioned, and flat short term rates are expected to remain unchanged in future. So, these are the categories on the basis of which we can form a yield curve in expectations theory. Then liquidity preference theory. This theory says basically criticizes the expectation theory. It assumes that investor know with certainty that what lies in future, because in expectation theory we said that we know what is going to happen in future, and on the basis of our expectation there is increase or decrease or rise or fall in the short term interest rate, and yield curve will form accordingly. But liquidity preference theory criticized it on this particular ground. It is a reality that future is unknown, because we already know future is uncertain. So, there is uncertainty about 1 year period return from a bond whose maturity is greater than one period. So, if a particular period you are going to calculate, you do not know what is going to happen within a period of 6 months or 1 year. So, in that case, if a bond is more than 1 year period, we do not know what is going to happen exactly. So, and this uncertainty regarding the one period return increases with the maturity of the bond. So, after a period of time, the rate of return on the bond increases as the year of maturity increases. Since investors are risk averse, J.K. Hicks argued that they require an inducement to hold long term bonds. Inducement in the sense they required a higher rate of return, that is interest rate. Investor want long term rate which is higher than the average expected future rates. To put differently, forward rates should incorporate interest rate expectation as well as the risk premium in this context. So, in liquidity preference what we are doing? We are expecting that future is uncertain, and for that also the investor required a risk premium, and that should be included in the amount of risk. So, here the formula is where TRN is the actual long term rate, N is the period of maturity, TR1 is the current year rate, TIR1 is the expected 1 year rate during the future period, and LI is the risk liquidity or premium for the year I. So, this is added in the formula, which brings more benefits to the context of expectation. Thus, according to the liquidity preference theory, an upward sloping yield curve suggests that future interest rate will rise or will be flat or even fall if the liquidity premium increases fast enough to compensate for the deadline in the future interest rate. So, if this situation happen, then only there are chances of rise in interest rate, fall in interest rate or flat interest rate, depending if the investor is getting more compensation for it or not. Next comes the preferred habitat theory. This particular theory suggests that risk premium increases as investor prefer liquidity investment early. Since the previous theory, the liquidity preference theory suggests that we should add amount of liquidity in the rate of interest. Here they said that borrowers favors long term borrowing, in the sense that liquidity preference theory suggests that risk premium increases as investors prefer liquidating investments early. So, if the situation, in that situation what will do? Borrowers will favor long term borrowing, because they also require funds. If the investors start selling their investment early, the borrowers will lose the money. So, in that case they prefer long term investment or long term borrowing, and the situation again changes from 1 year or less than 1 year to 1 year to more than 1 year. So, Modigliani and such introduced the preferred habitat theory, stating that investors prefer matching investment maturity with their goals. If the maturity period of the bond is matching with the goals of the investor, then only they are preferring investment in bonds, otherwise they are not preferring that in financial instrument. So, long term investors choose longer maturity instrument to avoid reinvestment risk, while short term investors opt for short maturity investments to avoid price risk. So, borrowers also prefer aligning borrowing maturity with fund requirements, because they required funds for longer period of time. In that situation they required a longer long term bonds. So, there is a mismatch between demand and supply in maturity range, because we are focusing on maturity period here, and while we talk about the preferred habitat theory, we are basically focusing on maturity, whether short term or long term. So, we have to match or align with the borrower and the holder. So, in this case what we have to do? We have to match the requirement of borrower and the lenders in the sense the bond holders or bond purchasers. So, we have to check the bond purchasers are matching with the borrowers, in the sense the corporates or government, their requirement is matching with the lenders or not. If it is not matching, in that situation there may be a difficulty. So, borrowers also prefer aligning borrowing maturity with fund requirement. If there is a mismatch between demand and supply in maturity range, may need to shift outside the preferred range with a risk premium as a compensation. If the borrower required a fund for 10 years and lenders are ready to give funds only for 5 years, in that situation what will happen? These particular lenders have to shift to this particular direction, and for that they required a risk premium. So, the shape of yield curve reflects future interest rate plus risk premiums, leading to various curve types depending upon the situation and economic condition. Next one is market segmentation theory. The theory is an extreme version of preferred habitat theory, suggests investors and borrowers sticks to their preferred maturity range. So, in the previous case what happens? If the borrower lenders feel that the borrowers are ready to give them the risk premium, they can shift or move further maturity period, that may, if they required they want to lend for 5 years, they can lend up to 10 years if they are getting risk premium. In this condition what happens? Both the investors and the borrowers are stick to their preferred maturity, they are not switching. So, this theory implies that yield curve is influenced solely by the demand and supply within the range, but it overlooks participants' willingness to move based on the market rates. In previous one we are focusing on that thing, that what is the demand and what is the supply, and if they are matching, then there is requirement that interest rate should be higher because risk premium is added. But in this situation both the parties are not ready to shift, and it is totally depend upon the demand and supply. It is going in the market, and on the basis of that the market rates are being decided. Next come to the determinants of interest rate. What are the major factors or that determines the interest rate? Inflation rate we have already talked about. If the purchasing power of money decreases, the people require more benefits out of their investment. In that case the interest rate should be higher. Real growth rate, what is the real growth rate of the economy or GDP growth or the economic condition? On the basis of that they preferred the higher interest rate. Time preference in the sense they are investing money for shorter period or longer period. If they are investing for shorter period, they may get lesser amount of interest rate. If they are investing for longer period, they need more compensation for that, and risk premium amount should be added to the interest rate and they should get a higher return. Then default premium in the sense business risk, which particular company is issuing the bond. If they have certain amount of its internal and external factors that causes business risk, in that situation the credit rating of the company also decreases and people will demand higher interest rate. Financial risk, again what is the capital mix of the company. If the amount of debt is quite high in the company, in that situation also the people demand higher interest rate. Collaterals, if the collaterals are provided, what type of fixed asset is collateralized against the debt instrument or bond instrument. If it is good enough to compensate the investors in situation of risk, then it is good. Otherwise, if there is no collateral, in that situation higher rate is demanded by the investors. Then certain special features, if it is a callable bond or puttable bond, we have already discussed in our first lecture. Conversion feature, if it is converted in equity shares, what is that particular feature. Other features like whether it is a straight bond or zero coupon bond, we have to look into that. These factors also influence the interest rate and help in determination of interest rate. Then maturity premium, basically the future expectation. If it is a longer period bond, then in that case the public will demand a better prospect from that particular bond, because they expect that the economic condition will improve and the company will earn a good amount of profit, or the government will earn a good amount of return on this particular investment. In that situation, they required a better premium. So, liquidity preference, what is the preference? It is easily sellable in the market or not, that is also an important aspect. Then preferred habitat, what is the preferred habitat? We have already discussed whether they demand, there is short term demand or long term demand, people are accepting the changes or not, what is the demand of the borrower, what is the demand of the sellers or the lenders, if they are accepting that particular thing, and what is their preference of investment. On the basis of that, this interest rate has been decided. Now coming to the implication of interest rate structure, first is economic outlook. The term structure is a key indicator of market expectation for economic growth, inflation and monetary policy. The upward sloping yield curve suggests growth, rising interest rate and potential inflation, and inverted yield curve shows slow growth, potential interest rate cuts and recession risk. So, on the basis of interest rate, we can check what is the economic condition of the particular country where the bond has been issued. Then monetary policy, it depends upon the central bank of the country, how they monitor the yield curve to gauge the market expectation, and what is the future expectation, that what is the economic condition, and on the basis of that what the investors expect from the bond. Then investment decision, investor can use the yield curve to decide on bond investment, interest rate hedging strategies and asset allocation. Then corporate financing, companies look at the yield curve when making financial decision like issuing short term versus long term debt and term structures of the, and how this particular interest rate is going to affect their borrowing cost. If borrowing cost is high and they are providing lesser interest, that is good, but if the borrowing cost is low and people demanding higher interest rate, that is good for the investor. So, they have to look into the impact of the structure of interest rate on the borrowings also, because that is going to affect their financing decisions. Now, what is the application of interest rate structure? First is bond pricing. The whole bond pricing is based upon this particular yield curve. So, if it depends upon the spot rate at which the bond rates has been decided. Then interest rate swaps. Swaps are basically the swapping between fixed rate options or future, we can say. These are the certain types of derivatives where we can use the swap option, swapping between fixed rate and the floating rate. It can be done if the rates have been decided earlier. Derivative pricing, again it is very crucial when we are trying to price the derivatives, because we need this particular bond rates for its pricing. Then risk management, institution use yield curve to hedging interest rate risk, estimating economic exposure and managing asset liability mismatches. So, these are the certain conditions on which the risk management can be taken care of. So, estimating economic exposure in the sense, if they see that the market is going down and the interest rate is increasing, in that situation they can change the interest rate. If they have the floating interest rate, they can change it. If it is fixed interest rate, they cannot change it. The managing the asset liability mismatch, depending upon what is the asset amount and what is the liability amount, they can check the mismatch, how the bond rates or the yield curves are affecting it. So, these are certain application of interest rate structures in real life situation, where the institution can take care of the financial position based upon this, and derivative pricing will be done. So, with this we come to end of this particular lecture. Thank you.